what is it that currencies traders, what kind of mindset do they have to be able to trade very well at the currencies market? Well, that's what we're going to be looking at today with Forex Time. Thank you so much, Bade, for being here. It's nice to have you back again. Yeah. Now, of course, as usual, let's quickly go into the general overview of the markets. We saw a broad rally this morning from Wall Street yesterday down to Europe this morning. And, of course, what's driving it is positive news we had from the Federal Chairman, Reserve Chairman, Mr. Ben Bernanke.
Yeah, so from the positive news, from the analysis on Reuters this morning, the speech by Bernanke actually gave the US dollar strength. And going by the data we've been getting from US since last week, the data from non-farm payroll, it's made the US dollars gain strength over major currencies. Now, going by the fact that a sign of strength has been, or a positive news has been carried about the United States, and obviously our brother Euro has not been doing greatly well, so it has been good for the US. And yesterday, coming from Monday till early this morning, what we saw was that the United States dollars has gained strength over most of these other currencies.
So comments from Mr. Ben Bernanke has driven growth in the dollar.
Yes, that's actually caused the dollar to grow against major currency pairs, and we are foreseeing that this is going to continue
for the rest of the day or for the rest of the week.
Even for the rest of the week, most likely.
Okay, now let's talk about what we're going into today, the psychology of successful traders. Now, when Mr. Tony Nathaniel was here on Monday, we talked about emotions, and he listed a number of emotions that traders usually experience or exhibit while trading. And of course, he did say that it's trading at the market is 20% skill and 80% emotion. So it's really all about your emotions, how well you can control and manage them while trading. But today we're looking at psychology of trading. So is there a difference?
It's all intertwined, and psychology of trading is a broader. It covers much more wider scope than emotion. Emotion is just part of the concept in psychology of trading. Now, what Mr. Tony did on Monday was to discuss some of those emotions that you see traders displaying over time. Now, a whole lot of time, yes, trading is not 100% about skills. It's like you said, maybe 20-30% about your skills and how you balance your emotion. But for about a week or two, I think 2 weeks ago, we were discussing about risk management. So it's actually a comprehensive course. Let me use the word course, because what makes a good trader is how he's able to work on his trading style, balance his emotion, work on his risk management strategy. And if you have a trader who has been able to pay close attention to all of this, then that trader on the long run is going to be successful at trading any market, not just the currencies market, because emotions are going to come in. When you are trading, there are times you're going to make profit, there are times you're going to make losses. There are some times that your profit margin will be so bigger than what you're expecting, and there are sometimes your loss are just too big. I think it was last week that we had the news that several billionaires in the world lost about $11 billion. So how do you explain that? So all of this, a trader or an individual who is able to manage and balance all of this over a long time is going to be successful at trading. So what we see a whole lot of times is that you see somebody trading and he feels that it's just about knowing how to get in the market and getting out of the market, and he pays little attention to other aspects that could form his trading. It's as bad as this. You can have 3 or 4 traders in, let's say, in a trading room, and they are all working with the same kind of information. They are all getting the same data feed. They are all getting the same signals to trade, and the 4 of them are going to have varying results.
Different outcomes.
Yes, different outcomes. So what is responsible? Their emotions. There are different levels of emotion. Understand? So the way they are balancing it, and the kind of personality that they have comes into play when they have to trade. So it's a key factor. When
traders, greenhorns, those the ones who want to start off, at the currencies market, or even those who have been at the market, when they approach Forex Time, when they come for your basic or advanced classes, do you have tools of assessing the kind of psychology they have towards trading, that's perhaps for those who are already trading and want to get better, or want to refine their skills, as it were. And for those who haven't traded, who just want to start out, is there a way of assessing?
Actually, it's in different phases. For instance, you come to me that you want to start trading, and I ask you, why do you want to trade? And you say, oh, I've heard that you guys make a lot of money in trading, so I want to trade. Rightly, I can...
No, that's a good incentive,
yes,
knowing that you Forex time makes a lot of money.
And there was a client who was a new client, and he came into the office and said, Mr. Badi, I want to get a car, and the car is $60,000, and do you think Forex can give me the money? I said, why not? And he said he wants to trade. I said, how much do you want to trade? He said he wants to trade $2,000, and he wants to buy the car in the next 2 months, so he wants to trade $2,000 to $60,000 in the next 2 months.
Meaning he wants to make that profit, whatever the conditions of the market.
That margin, $2,000 to $60,000 in 2 months. So these are some of the things. It's a product of what he has at the back of his mind. Understand? So that kind of attitude alone can tell you that this person is heading for the rocks. So, but on the other side, for those who have been trading or who have just started trading, sometimes you are able to assess it on the long run, because some of these things comes by experience. Your emotions, your attitude, they are all shaped by the kind of experiences that you have that you've actually experienced during your trading career. Yes, and so it's not difficult it's not really easy for you to say, okay, this and this and this is what you are going to do, because we are not robots.
But as a Forex expert and trainer, don't you think it's better to just tackle it right from the start? You have somebody coming in.
The problem is there's, for instance, when you talk about excitement. For last year around this time, we had some student coming in, and there was this particular student who started trading an $100 account, and in about 3 weeks, it took his $100 to about $300. He took some profit off the market, and this kind of excitement came in, and it's just about a month old in currencies trading, and he felt he knew it all. So there's this super excitement that, wow, so this is how the market is, blah 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 blah. The next thing, in about 2 or 3 weeks, because the emotion was not guided.
But was it a normal emotion? Is it a normal thing?
Emotion is normal. You cannot separate.
Having been very optimistic at that particular point, knew at it and making gains.
Being optimistic is not a problem, but when you don't consider all the variables, which I'm going to talk about shortly, when you don't put all the variables into context, then your optimism might not be well channeled, and before you know it, in a couple of weeks or a couple of days, all your supposed gains run back into the market as losses. And that's what a concept like excitement can do. And here's another trader, his first experience with the market is that of a loss. So maybe invested money in the market, and let's say in a day or two he wipes out all his capital, and he was like, wow, so this market can be this
volatile,
risky, and this fear comes into the trader, and it puts a stigma on,
because perhaps too timid to make calculated risks.
And by the time he wants to take a trade, maybe there's some trade he's supposed to take normally that could have made him gains, but because of the past experiences had, that fear limits him. And of course, when you ask him a question, he said, no, I've had this experience, I don't want to lose again, and blah blah blah. But that's not actually the problem. That's not actually the problem. But he is suffering from the fear of losing. And excuse me, in this market, you're going to make gains and you're going to make losses. You understand that? JP Morgan this morning was declaring a super dividend for. But there are sometimes JP Morgan will come out to declare a loss. You understand? So in this market, you make profits, you make losses. But how do you balance it, and how does it come? How does it frames up with your personality? That is the picture.
Let's look at the different types of, how do I put it, psychological mindset of traders.
Now, the first one is that of excitement. The second is fear. The second is greed. Talking about excitement, excitement is when you get into the market, you place a couple of trades, you're making so much profit, you're excited. And you feel that the market will continually go like that in your favor. Now the second one is fear, Now, fear is that you invested in the market and you lost a large chunk of your capital. Now, greed is the fact that you don't know when to say stop. All right. Now, because of the potential that exists in the market, number one, you don't know when to say stop. Number two, you don't know when not to take an unnecessary risk. So greed can allow you to take risks that you're not supposed to take in the market. Now, these three components, they go hand in hand. Now, when you see a trader that or is unnecessarily excited, for instance, there was a trader 3 weeks ago. Anytime he comes to me, he tells me, wow, I just made like 30% of my account in a day trading. I just made like 40% of my account in a day trading. It's like, but there was a time he made about 50% to 80% loss. I get in the picture. Now that is excitement. It's overly excited while leaving other variables.
You mentioned excitement, greed, and fear. I was also going to mention the fact that greed and fear, isn't that the two main themes that drive markets on a daily basis?
Greed and fear are two things that drive the market, but what you see is that those people living in that realm of greed and fear are often the ones that lose their market to the money, and they lose their money into the market because they don't have a balance. Number one, anybody going into a business has a clear-cut plan. Now, we have the saying that if you don't plan, you have already planned to fail. If you don't have a plan, you've planned to fail. Now, when you come into the market, you are not guided. You don't have a trade plan to follow. You don't have a roadmap. You understand? Now, there's a danger of you getting to the extremes. Now, fear takes you to the extreme. Now, this is what fear does to you. Now, you've been trading and you have a setup. Usually what we call a setup is a signal. A signal means that, okay, this is time for you to buy or this is time for you to sell. Now, your setup comes up and you have an opportunity to take a position in the market. But because of your past experience of a loss, you now decide that you are not going to take that position. At that point, you are not thinking right. You are falling for your emotion, and that emotion is not emotion is not part of your trading plan. It's not part of your trading roadmap.
Or rather, how to manage it.
Yes, managing it is even another thing. When you are drawing your trading plan, you say, okay, when I see this and this, I'm going to take a buy. When I see this and this, I'm going to take a sell. You understand? But because you've had a loss from your former trading, that emotion aspect comes into your trade plan. So a trade that is supposed to actually give you profit or make gains for you, but because you are so afraid, you don't take that gain. You don't take that trade. If you don't take the trade, that means you don't have the gain. Now, on the other aspect, somebody say, okay, I placed the trade, but because of my stop out, what we call a stop loss, I was taken out of the market very early. And the next thing the client told me was that he said, this stop loss thing, the market keeps eating my stop loss out, so I'm not going to use stop loss again. So he removes his guard and begins to play to the he begins to play out his emotion, not his trading strategy. So what these attitudes, fear, excitement, greed, and what they actually do is that they allow you to forsake your trade plan. All right, that's if you had any at all. They shift you away from the direction of your trade plan and they put you into reckless trading. And usually, I used to say this, there is a thin line between investment and gambling. Now, what makes your trading and what makes your gambling is a trade map. All right, is a trade plan. And a trade plan involves a good trade setup and a robust risk management. All right. Now, once you remove this from your trading business, you have tilted yourself to the side of gambling. And so the kind of result you get is random. You understand? It is not planned. And if the major institutions in the world are running their business like this, for instance, when you look at the major players in the foreign exchange market, it's not just retail traders. Retail traders comes at a very low level of players. Okay. So if the major participator in this business, if what they do is just to throw caution into the wind and just act randomly and do you think that the financial system we're having now, do you think
okay, but that being said, how can one strike a balance, and how can you tell when one is a balanced, psychologically balanced trader?
A balanced trader, number one, must actually go back to his drawing table to develop a plan. A plan. Now you must have a trade plan. A trade plan is what guides you. You can't have an architect building without the plan. Julius Berger is the construction, they construct road. Do they just go to the road and just pour the stuff? They have a plan. Can
this plan be done by the trader? Can the trader have some help, support?
Yeah, a trader can have help. If you come around us, we can help you. But most especially, the internet is there. Understand? You can do a research on the internet. When you do research, you'll be able to draw up a plan. Now, when you draw up the plan, the next thing is that you need the discipline to follow your plan. Now, I must acknowledge at this point that following your plan at the initial stage is not easy. You understand? Most especially if you are in the side of excitement, when you have been making so much gain in the market and feel like, well, I can just drop this plan and just follow the excitement. You understand? But if you have a plan, you'll be able to make your check and balance. All right. Your trading emotion, your trading psychology flows along with the plan that you have on your trade setup. So, okay, I want to invest my money as a trader in the currencies market. What strategies do I want to use? One. Number two, what is my risk and what is my potential for returns? Number three, it's even as bad as some traders think that they have to sit down like 24 hours at the back of their system monitoring the market. These are part of the attitude we are talking about. So, but if you have a trade map, your trade map can even go to the point of say that this and this time, these are the various times that I want to trade in the market. So when you have this, then you now have to imbibe the discipline of always going back to review what you have done so that you can measure how much you've deviated from your plan. Now, if you have deviated from your plan, you now seek corrective measures to go back to your plan. Because on the long run, you will not win in this market by acting randomly. You win by your plan. And that is what the major financial institutions are doing. That is what the successful players in this market are doing. So if you don't have a plan, if you don't have the discipline to follow your plan, like I said, it's going to be hard. But most of the successful traders in this market have actually gone back to discipline themselves. So what I'm saying to traders now is that they need to take conscious steps to discipline themselves, create their plan and follow it.
Okay, well said, Bade. Thank you so much for that. I'm sure viewers have been listening. I'm sure currencies traders who are actively trading at the market have heard that, you need to control your emotions. Like he said, 20% skill, 80% emotions. Well, we know we have greed, fear and excitement at the market. Those are not bad, but it's managing them that's the core issue. Then, of course, most important, discipline when you're trading. Don't get too excited and don't become too timid if you have one or two bad experiences. Just keep at it and try to balance them out. Well, I've been talking to Bade Ajidan, the currencies analyst from Forex Time, and we have been looking at the psychology of trading. Well, that's about all we can take on today's edition of Business Morning. Thank you so much for being a part of it. I'm Esther Ogbodaga. Channels News Track is at 11. Bye for now.